Have you ever wondered how some people seem to multiply their wealth effortlessly through the stock market? It might seem like magic, but there's no sorcery involved. It's all about understanding the fundamentals and making informed decisions. Picture the stock market as a bustling marketplace, but instead of fruits, vegetables, or clothes, what's being exchanged are shares of companies. These shares represent ownership in those companies. When you buy a share, you're essentially buying a piece of the company. You become a shareholder, an owner, albeit a tiny one, in a potentially large corporation. Now, why would anyone want to own a piece of a company? Well, the answer is simple. Companies exist to make profits, and as an owner, you're entitled to a portion of those profits. If the company performs well, the value of your shares goes up, and you can sell them for more than you paid. This is how investors grow their wealth. But what if the company doesn't do well? That's a valid concern. The value of your shares may decrease, and you could potentially lose money. This is where strategy comes into play. Successful investors don't just randomly pick stocks like choosing a lottery ticket. They research, they analyze, they strategize. They look at the company's financial health, its competitive position in the industry, the quality of its management, and many other factors. And even after all that research, they don't put all their eggs in one basket. They diversify their investments across different companies, different industries, even different countries. This way, even if one company doesn't do well, the others may offset the loss. This is the intriguing world of the stock market. It's a place where patience, research, and strategic thinking can lead to wealth creation. But it's not a get-rich-quick scheme. It's not a place to gamble your hard-earned money. It's a platform for serious, thoughtful investment. Remember, the stock market isn't a casino. It's a platform for investment based on research and strategy. To navigate the stock market successfully, understanding some key concepts is crucial. Let's start with stocks. Simply put, a stock represents ownership in a company. When you buy a stock, you're buying a piece of that company, making you a shareholder. The more stocks you own, the larger the part of the company you own. Now, you may have heard the term shares used interchangeably with stocks. That's because they are essentially the same thing. A share refers to a single unit of stock. So if a company has 1,000 shares of stock and you buy one, you own 1,000th of that company. Next up, we have dividends. These are a portion of a company's profits that are paid out to shareholders. Not all companies offer dividends, but those that do typically distribute them on a regular basis, often quarterly. Dividends can be a great way to earn passive income, as you're essentially getting paid simply for owning the stock. Capital gains is another term you'll often hear in the investing world. This refers to the increase in value of an investment. If you buy a stock for $10 and later sell it for $15, your capital gain is $5. But remember, capital gains aren't realized until you actually sell the investment. Until then, they're just potential gains. So, how do these concepts work together in the investment process? Well, when you invest in stocks, you're hoping for two main things. First, that the company will be profitable and pay out dividends. And second, that the value of the stock will increase over time, leading to capital gains. Investing in the stock market is a balancing act. It's about understanding these concepts and using them to make informed decisions. It's about assessing risk, diversifying your portfolio, and having a clear investment strategy. With these concepts at your fingertips, you are well on your way to becoming a savvy investor. Ever heard the saying, "Don't put all your eggs in one basket"? This concept applies to investing as well. When we talk about diversification, we are essentially referring to the practice of spreading your investments around. Think of it like a buffet. Instead of loading up your plate with just one dish, you sample a little bit of everything. This way, if one dish isn't to your liking, there are plenty of others to satisfy your palate. In the context of investing, diversification means investing in a variety of stocks, bonds, and other financial instruments. It's like crafting a financial buffet. This strategy is used to manage risk and potential losses. If one stock performs poorly, it's okay, because you have other stocks that are performing well. Diversification can be achieved in various ways. You can diversify by investing in different industries or sectors, like technology, healthcare, or consumer goods. You can also diversify by investing in different types of investments, such as stocks, bonds, and real estate, and you can diversify by investing in different geographical regions, spreading your investments across the globe. So why is diversification important? Well, the market is unpredictable. Stocks rise and fall, industries flourish and flounder, economies boom and bust. By diversifying, you spread the risk across a wider range of investments. This means that even if one of your investments tanks, you have others that can balance out the loss. Moreover, diversification can also increase the potential for profit. By investing in a variety of stocks, you open yourself up to more opportunities for growth. Each stock has the potential to rise, and having a diversified portfolio means you have more chances to catch a rising star. But remember, while diversification can help manage risk, it doesn't eliminate it entirely. It's still important to do your research, understand the risks involved, and make informed decisions. Diversification, a simple yet effective strategy to spread risk and increase potential for gains. Investing isn't a get-rich-quick scheme. It requires patience and a clear understanding of your financial goals. Now let's delve into the world of long-term versus short-term investing. Imagine two friends, Alice and Bob. Alice is a long-term investor, while Bob is a short-term investor. They both invest in the same company, but their investment strategies are as different as night and day. Alice, the long-term investor, buys and holds her shares for many years. She's not swayed by market fluctuations. She's in it for the long haul, believing in the company's ability to grow and prosper over time. This strategy often results in lower transaction costs and less stress about daily market movements. However, it requires patience and a willingness to weather potential downturns. On the other hand, Bob, the short-term investor, buys and sells shares frequently, hoping to profit from market volatility. He believes in the saying, "Buy low, sell high." His strategy could potentially earn him quick profits, but it also comes with higher transaction costs and the risk of significant losses if the market doesn't move in his favor. Both Alice and Bob can be successful in their respective strategies, but their success largely depends on their financial goals, risk tolerance, and investment knowledge. Long-term investing is often associated with lower risk and steady growth. It's a tried-and-true strategy for wealth accumulation, suitable for those aiming for retirement or long-term financial goals. Short-term investing, however, can be more exciting and potentially more lucrative, but it requires a good understanding of market trends and a high tolerance for risk. It's a strategy that may appeal to those who are comfortable with uncertainty and have the time to closely monitor their investments. In summary, there's no one-size-fits-all approach to investing. What matters is understanding your financial goals and choosing a strategy that aligns with them. After all, investing is not about getting rich quick. It's about steadily building wealth over time and making informed decisions that align with your financial objectives. Whether you're a tortoise or a hare in the race of investing, knowing your financial goals will lead you to the finish line. What if I told you that time could be one of your greatest allies in investing? Yes, you heard it right. Time has the power to turn your pennies into pounds, your dollars into dynasties. This magical phenomenon in the world of finance is known as compound interest. Now, let's break it down. Compound interest is the interest you earn on both your original money and on the interest you continually accumulate. Think of it as interest on interest. It differs from simple interest, which is calculated only on the initial amount, or principal, that you invested. Imagine you're planting a tree. The tree represents your initial investment, and the fruits it bears are the interest. With simple interest, you only get to enjoy the fruits. But with compound interest, you not only enjoy the fruits, but also plant the seeds from those fruits, which grow into new trees bearing even more fruits. Over time, you have a flourishing orchard from just one initial tree. The real magic of compound interest is seen over long periods. The longer you leave your money invested, the more time it has to grow. That's why it's often said that time in the market is more important than timing the market. Let's consider an example. If you invest $1,000 at an annual interest rate of 5%, after the first year, you'll have $1,050. Now, in the second year, the 5% interest is calculated not just on your original $1,000, but on the $1,050. This process continues year after year, with your money growing exponentially. So, are you ready to harness the power of compound interest? Begin your investment journey as early as possible, stay patient, and let your money work for you. Remember, the eighth wonder of the world, as Albert Einstein allegedly called it, is compound interest. Compound interest, the secret ingredient to growing your wealth over the long run.